Welcome back to Behavioral Finance and FinTech. I'm going to talk about momentum strategy this time. Momentum, well, what is that about, right? Looking back in history of your stock price movement, right? If the price of the stock has been going up, then it's going to keep on moving up. Kind of an inertia going on, right? Momentum. If the price of the stock has been going down, until now, it's going to keep going down. Keep on running the same direction. Keep on running, baby. Ooh, yeah, that's the momentum idea. In the short run, by the way, if you test it, the thing is, the momentum phenomena is commonly found in the United States and some of the markets. Other markets, it's not found. But momentum, right? It's a starting point of quantitative trading, but this is really based on what? Technical analysis, looking back in the price history. What happened will keep on happening. Can you make money by looking back in history? Historical information, is it informative? Is it useful to predict the future returns? Weak for market efficiency said what? No, you cannot. No. But momentum says you can. So momentum holding, yeah? Momentum is found in a certain market that says weak for market efficiency is broken down in that market. US market, oh my God, weak for market efficiency broken down. Hey, isn't US market the most developed market? Yeah, but it's still, you find this kind of phenomena going on. Very strange, very interesting. Now, momentum in a regression framework, how would it work? Yeah, return, right, of today or future, let's say, going forward, future return. Let's try to predict it using past return, right? Past return, does it explain future return using historical data? Okay, 1 month ahead return versus the previous return. You keep on running this regression and see if the coefficient is any significant, especially whether this gamma, the coefficient is positive. Positive return, positive future return. Negative past returns, negative future return. That's nothing but momentum. That's the idea. How much do you have to look back in period? Well, usually the literature says that 3 months or up to 12 months like that, or monthly basis like that. Okay? Doesn't go beyond 12 months, right? It's a short horizon. Winner will continue to win, loser will continue to lose. Yeah, that the momentum keeps on happening. Jagadish and Titman are the research teams that developed this paper about momentum. And they find a big momentum effect. 15% average annualized return difference between the highest and lowest momentum portfolios. How would you construct that momentum portfolio? Please bear with me. Here you see Jagadish and Titman, professor. He's in UT Austin, where Global Business Administration graduate, is a PhD student in finance over here. Right? So Park Hyung-gyu is studying over there right now. And then portfolio construction. Yeah, how would you construct a momentum portfolio? Okay? Well, this is simple and easy. Just line up, okay, 줄 세워, based on one category, which is past return. Okay, look at the past return. Well, set up the horizon. Let's say 3 months. Let's say 3 months over the past 3 months. Line up. Okay, sort it. Okay, portfolio sorting. You're gonna sort the portfolio like crazy. In this kind of quantitative trading, sort it, and then there will be top to bottom percentile, 10 percentile, top 10 percentile to bottom 10 percentile, all the way down, right? And then you call this a winner portfolio and those as loser portfolio, top performers and bottom performers, right? And then what do? Because this guy you expected to go up, you take a long position, okay, to make money. And because you anticipate this guy will keep on losing money, you take a short position. and that is going to be, loser portfolio. So your momentum portfolio or UMD portfolio, its return, okay, momentum portfolio's return will be nothing but RU minus RD, RU minus RD. That, okay, is in, practically that means you're taking a short position of this loser portfolio. And then once you take a short position of this loser portfolio, you immediately get the cash because you short sold it. Okay, short selling gets in over here. And then with that cash, what do? You buy this winner portfolio, long position. Long short portfolio forming works that way. You don't need to put your additional cash. You start with zero amount of money and then short sell first, and then with that cash, take a long position. Self-financed portfolio, you take it that way. That's arbitrage portfolio, we call it. And then this kind of portfolio, we call it also our mom. This is not mommy mom. This is momentum portfolio. Mom and dad, no way. Okay. And then you can alternatively call it our UMD, up minus down. So this is up portfolio minus down portfolio, UMD. Okay, not University of Maryland. Come on. How does momentum portfolio have performed over the past, almost 100 years in the U.S. market? Performed very well, seems like. If you don't take logarithm scale, right? If you take logarithmic scale, it looks like this red line, cumulative log excess return. And then excess return with respect to what? With respect to what is it? The risk-free asset. Let's see. This figure plots the cumulative return of the MOM factor for the period from January to 1927 through December 2012, right? The compounded excess return for months T is calculated as 100 times the cumulative product of the 1 plus the monthly return up to and including the given months. The cumulative log excess return is calculated as the sum of the monthly log excess return up and including the given months. So momentum portfolio's excess return up minus down. If you keep on accumulating, it will look like this. The thing is, it has been performing very well, very persistently, with some exceptional time points. There is some momentum crash that you see in Great Depression. There was that the stock market crash in 1929. Ever since that, you see a Great Depression happening there. When did you recover it? Well, it took more than 20 years to recover that, point over here. And then the momentum has been going up, doing well, with some bumps, with some momentum crash over there, like this. This is 2008 financial crisis, right? And you see another momentum crash like this in 1997 and 8 East Asian financial crisis. Obviously, these are the time the peak of the bubble, and then as the bubble bursts and the crashes, this is a time when the momentum performs worst, because momentum is a trend chasing. Whenever bubble takes place, follow the bubble, and then when they crash, die together with it. Momentum crash. That's it. Okay. So if you look at the recent time period, my RA drew this graph like this, and then wonderfully he drew it with R code, and then this is the momentum of factor returns, of cumulative momentum returns for US market, the 1960, that's this period, since this part until that, and then going even further up until 2020. Right, you see momentums going well most of the periods, except for crashes like this, right? And whenever the crash happens, it takes a long time to recover that position, right? And how about momentum factor in Korea? Not much, right? It was not much performing well. If you look at the magnitude, it's a lot different, a lot smaller, and it's not there, right, in Korean market. And then Jagadish and Titman they tested with regression framework. Instead of back testing like this, they were running some calendar time portfolio method of something called calendar time portfolio method of testing it. So they showed it like this. They showed it like this. What they show in each line, first each odd lines are the alphas based on CAPM. Okay, based on CAPM, assuming CAPM is correct. Assuming CAPM is correct, let's see if those alpha of CAPM is any different from 0. Okay, testing CAPM using momentum portfolio strategy. Okay, what you see is that the alpha, okay, of this momentum portfolio forming over here, right? But before that, let me explain one by one. What you see on the vertical axis, 3, 6, 9, 12. Those are the look back periods. 3 months, 6 months, 9 months, and 12 months. You look back and sort the stocks in terms of their past performance. And then short sell those loser stocks and buy those winner stocks. So up minus down, buy minus sell, or momentum portfolio return will be this one. Okay, buy minus sell for 3 months, 6 months, 9 months, and 12 months. Look back period. And then that's J period. K is what? Is moving ahead, going forward, right? 3 months ahead, 6 months ahead, 9 months ahead, and 6 months ahead. This is the holding period of your stock. So short sell, and how long do you short sell? 3 months, 6 months, 9 months, and 12 months. Buy long position. How long do you hold that long position? 3 months, 6 months, 9 months, 12 months, right? By looking back 3 months, right? You form different time point portfolio. And then buy minus sell is the essence of momentum portfolio. Winner minus loser portfolio. And then you see that monthly average return, right? Monthly alpha based on CAPM is 0.0069, which is 0.69 percentage point, 69 basis points. That's positive. And then the question is it statistically significantly different from 0? And 3.53 T-statistics tells us that alpha over here is very significantly positive. We reject the null that CAPM either market is efficient or CAPM is correct. At least to the extent that the CAPM is a correct asset pricing model, you can make money, significant money, risk-adjusted money when you form momentum portfolio like this. Or different time look-back periods, right? 6 months like this, 9 months like that. Wow, 0.82 percentage point return with this statistical significance. And then 12 months, 68 basis points. Statistically significant at 5% level. Now panel A is like look back for 3 months and then immediately look forward and form a portfolio and start the position, okay? And then hold it 3 months. Panel B is about look back 3 months and then form a portfolio. Oh, these are the winners and those are the losers, and wait 1 more month and then form a portfolio and go forward, okay? Past winner, and then would it be a future winner even if we wait 1 more month? And then does it still win? Yes, it does. Okay, the momentum sustains in the short run even if you wait 1 more month, right? So that's that. Now assuming CAPM is correct, you found that alpha is not equal to 0. You reject the null, right? Now what? Does that mean that the market is inefficient? Or does that mean that the CAPM that you assumed to be correct is wrong? Wrong model for risk-return trade-off? Or both? We will get back to this issue later. We call it, there's joint hypothesis problem associated with it. At least in the momentum strategy, well, you can ask this question. The momentum, right, is that just another risk factor? I.e., CAPM is not enough to control for the risk in estimating the expected return. Okay, are high momentum stocks just somehow riskier? That is not properly captured by market risk factor. No pattern between momentum and size or beta is there. Okay, is momentum portfolio giving better return because of high beta or lower beta? No, it doesn't matter. It's not a function of beta. Regardless of the beta, the momentum return is there. And size, portfolio size, is it a matter of big stock or smaller stock? Not to that much, right? Jagadish and Titman's table 2 tells us about it. And another apparent violation of weak form market efficiency. This is, together with calendar effect, momentum is a violation of weak form EMH. Momentum is used by many hedge funds as their base strategy in quantitative trading. Okay, is momentum a function of beta, existing, market risk, or size, right? The answer is no. Jagadish and Titman show in their table 2. In what respect? In what way? Well, they form a portfolio of winner versus loser, like all the way down, past performance, right? Best performers to worst performers, and estimate their betas of each different stocks, right? And those betas are not that much different, regardless of whether you are winner or loser. Okay, it's not a function of beta. It's something independent of market risk. And then size. For winner portfolios all the way down to loser portfolios, their market cap is not that much different. It comes and goes, right? That's what they find. Now, one interesting recent finding about momentum, right, is that suggests that it seems to be associated with some color, right, that you use in your graph of stock price chart. What? It seemed to be related to some user experience somehow. What you see in your price chart, right? If it is red, it brings us more. If especially it's going down and then price going down shown with red color, it scares you off and adds to the momentum. Loser, keep on being loser. Right, that's the idea. 빨간 맛, yes. Red velvet. Color coding, right? Color psychology matters over there. Color is significant tool of communication. Red is associated with something dangerous, blood, fire, etc. Like 붉은색, 푸른색, it's like a red color and then green color, depending on what the traffic light directly tells you. Stop, right? You have to warn you. Stop sign everywhere in the world is red color, right? Cultural learning effect in China is the opposite, except China. Chinese culture, red is something good. It brings you some blessing, 祝福, right? I don't know why, but they have it there. So that can be a good contrast group, all right? Control group later on in the experiment. But here is let me tell you some basic biological research going on over there. Sarah Khan et al. In Psychological Science 2011, they had this kind of interesting research about animals. The monkey, rhesus monkey, they have their eye vision, the color recognition is the same as human beings, they say. And then the thing is the monkey afraid of red color? How do we test it? Well, for their monkey resident area, two people go there with identical tools, with the same apples, right? They go approach to the equal distance to the monkey, and then show their box, the styrofoam box, and then the apple. Show it to the monkey. Here is your apple. Yummy. And then place it. Okay? Two people do the same thing. Place apple. Yummy, yummy, yummy. And then they stand and then step back. Right? Step back. One person wearing red shirt and the other wearing other colors like blue or green. Then this monkey which side would it come and pick up the apple and eat it? He will choose the one with the less scary part, right? Less challenging or less domineering color. So where does he go? Usually, on average, the guy end up with non-red colored person's apple. Okay, that's the result over here. See this, right? Regardless of the gender of the experimenter, and then they just end up with non-red color. Now, the red color is known to be a threatening color in combative sports. Some researchers in Britain published in Nature a paper like this. They looked at Beijing Olympic combative sports, 1-to-1, combative martial art. It's like Taekwondo, hey, hey, and then boxing, yes, and then Greco-Roman wrestling, and then freestyle wrestling, 4 different kinds. Why? Because this is an ideal setting, because in each match, they randomly assign red color versus blue color to these players, right? Completely randomly. And then see which side wins, right? So is color related to the outcome of winning and versus losing? Red wins, they find that red wins more frequently, especially when there's a least difference between the two players, when the ability is almost the same, right? They're 기량이 똑같으면, it's like other things being equal, the red color is more threatening looks more threatening to the competitors over there. So this is what they report. Or, yeah, red winning probability is higher, 55% for 45% over there. Boxing, taekwondo, the wrestling, and etc., etc. And then the degree of asymmetry of ability, none, and then which means equal track record or something, right? Their ability, small, medium, large, right? So that's an interesting finding. At least you can see that the red color is known to be having some threat potential, right? Makes people stunned, like careful, the red light, red flag, right? Traffic light, red light, no, yeah. Okay, now bring it to stock market. How? Even before stock market accounting, when you make a loss, they say you are in the red. They don't say you are in the blue, right? You are in the red, losing money. That's something warning. Stock market, when you represent or display the loss of your stock investment in red color, would it be more scary or less scary? Would you hate this stock more or not? Okay? They experimented in Cronquist, Henry Cronquist of University of Miami, tested this and published in Review of Financial Studies last year or the year before. And what they found is that the investment loss is shown in red color. People tend to avoid that stock even more, as opposed to the shown in black color. Okay, it's the same thing. If you show the graph in money-losing stock in the red graph, they tend to avoid more. Okay, red avoiding. Okay, as opposed to showing it in other colors like black, right? Red avoiding. Doesn't it add to momentum? Because declining stock, if the investors tend to avoid more, that would be the demand going down for this kind of money losing stock, which means the price will go even further down, which adds to the momentum. Loser keep on losing. That's an interesting idea. That's a suggestive idea based on this result, right? Important thing for your fintech purpose, maybe user experience, what you see as a color. Be careful about the red, okay? How would you show it, right? The same number with different colors matters, especially if it is red. That's the thing. US market, yeah, if you look at the graph, any money losing stock, not just the graph, but the numbers. Red means money losing. And then candlestick chart representatively. Yeah, very, very important one. US market, red means going down. right? Bearish. Green is something, green color, green light를 보여줘. It's like something, okay, go. And then that is a stop. So doesn't it add to the momentum that we've seen in the US market, right? The back testing wise. Japan, and the same thing, the red is down and blue is up, okay? Historically speaking, Japan is the first one at the end of 19th century. They invented this candlestick chart. Of course, 130 years ago, right? They could not use color ink, so that they had to represent it with filled black box versus empty box, right? But as they could use some colors, they started to use red as down. But as time went by, they got mixed. They show red number as a loss as a red number, but it's mixed right now. They sometimes show money gaining as a red color in their candlestick chart. But the thing is, in Japan, the momentum is not present, not as stark as in the United States. And Korea and China, we don't have momentum, okay? And then the thing is, China, red color is not avoided that much. Not avoided, but it's preferred culturally. Is how do you say? Almost like brainwashed, and then almost like from there, culturally, whenever they celebrate good things, they celebrate it with only one color, red. So they don't avoid red color. And then somehow Korea follows, in that sense, Chinese convention, showing those red market move upward is with red color, and then downward movement with blue, right? So they don't avoid this money losing stock that much in Korea, I guess, or China. Okay, so that maybe the momentum is not present in these two markets because of this color effect. The long run reversal effect, or long run overreaction. Okay, long run reversal. Well, this is quite opposite to momentum. Here, in the long run, those stocks that have been extremely performing well will go down, and those stocks that have been extremely performing bad will be performing good, right? And so that if you run a regression, like future return on past return, the coefficient gamma will be negative, not positive. That's a prediction. Remember, this is a breakdown of weak form market efficiency, right? This is past return, should not be able to predict future return in whatever way, but it tells us that it is negatively predicting. Shouldn't it be positively predicting? That's a momentum, right? Remember, momentum is about short to, within 1 year horizon, short run, right? But long run reversal, this is more about 3 to 8 years, long period, outperformance, long period of bad performance. And then in Korean terminology, 지구명에도 볕들라 그런다 kind of things, right? When you have after a terrible time for a long period, eventually you will see the sunrise, right? DeBont and Taylor are the scholars that found out this long run reversal. Is that Taylor, the nudges Taylor, the Nobel Prize winner? Yes, he is. And then compare future performance of extreme winner and loser stocks as measured over past 5 years. And the thing is, momentum, not only the time horizon is different, momentum was like 10 percentile. So if it is a US market, then in that period, they had like 6,000 different stocks. So 10% is like 600 stocks. But long run reversal, they look at extreme 35, top 35 out of 6,000, bottom 35 out of 6,000. So a lot smaller number. Okay, this is what they found. And then what they at the bottom, Taylor looks like this. Loser stocks keep on making money. Winning stocks keep on losing money. Okay, so if you take a long short position, you will make this amount of money over the 60 months, right? If you hold a portfolio like that, huge amount of money will be made. Isn't it a breakdown of weak form market efficiency is the argument, okay? Now, if you come back to the momentum, right? Lead lag effect is also an extension of momentum, right? Lead lag effect across different stocks, right? There seem to be some lead lag effect. What do you mean? Large stocks seem to lead small stocks over a horizon of a few weeks. For example, in Korea, big stocks like chaebol stocks, right? Samsung, Hyundai, and all these kind of companies, stock goes up high first, and then subsequently, smaller stocks follow and go up. Trailing effect, right? Goes up. And Samsung goes down, a small stock goes down together with it, right? That's lead lag effect across different stocks. This is a breakdown of weak form market efficiency, weak form. Why? Because large stock performed good or bad in history. That's a history, right? That history has to be priced in the stock price of the small stock price, right? Regardless of my stock or your stock, all those history has to be already priced. That's weak form market efficiency. But this one tells that it's not, right? Your stocks, right? Your history is not still priced in my price. Okay, that's a violation of weak form market efficiency. And now you realize, those market efficiency was claiming much more than what we anticipated usually. Not just my history, but your history and everybody else's history. Whatever you can infer from the historical data should be already priced in my stock price. That's what the economist means by weak form market efficiency. I see. Okay, so that's lead lag effect. It's another pattern, right? And then the lead lag effect could contribute to an industry level momentum. Some industries, if you look at the, what should I pick? Semiconductor, right? Big semiconductor company like Samsung Electronics first go up, and then their semiconductor testing company or equipment manufacturer, which is in the behind the value chain, right? Those same industry, but big guys and small guys, right? Big guy leads, and then small guy follows. Overall, the industry momentum happens together with it. Samsung tanks, and then the semiconductor producer, the equipment manufacturers follow the suit, and then the tanks. Now, I'm afraid that the Samsung Electronics price was going down recently. And what does that tell us about the future of Korean stock market in the short run? Maybe there will be some lead lag effect. The smaller stocks in Korea will follow the suit. And then the semiconductor equipment companies will go down together with it. The industry cycle of semiconductor, the memory chip, is huge. And Samsung was leading the way. Okay, so that's what we can predict. Anyway, drag around, yeah. And then industry momentum, right, Moskowitz and Greenblatt is the one who found out this phenomena, right? This is a violation of weak form market efficiency, right? And notice that this kind of violation of weak form market efficiency happens in the US market as well. The fact that the US is well-developed capital market does not necessarily mean that it never has violation of weak form market efficiency, right? So we have to be careful. Now, next one, we're going to talk about the evidence against EMH in terms of semi-strong form market efficiency. So wait for that. Thank you for watching.